The market's a funny thing. It doesn't care who you are, what you've studied, or how smart you think you are. It'll chew you up and spit you out if you don't play by its rules. Today, I want to talk about those rules, the simple rules every trader must know. And if you caught the previous video on 4 mistakes traders make, you'll remember how those mistakes can ruin even the best trading setups. Well, today we're going to fix that. We're going to build the foundation that keeps you from making them again. Now, let me tell you something I've learned from years of trading. There's nothing new in Wall Street. The game doesn't change because human nature doesn't change. The same greed, fear, hope, and ignorance that moved prices 100 years ago are the same forces moving them today. And if you think you're immune to them, let me ask you, have you ever watched a trade move against you and told yourself, it'll come back? That's hope talking. Hope doesn't belong in trading. Rules do. Rule number 1. Cut your losses quickly. I've said it before, and I'll say it again, a trader who can't take a small loss will one day take a big one. The market doesn't care about your opinion. It doesn't owe you a bounce. When the tape tells you you're wrong, step aside. Small losses are like an insurance premium, they keep you in the game. The man who hesitates, who argues with the market, who hopes for mercy, that man's capital will be gone before he knows what hit him. You see, the difference between an amateur and a professional isn't luck, it's discipline. Professionals don't try to be right, they try to make money. That's an entirely different mindset. A professional trader asks, what does the market think? Not what do I think? Tell me, do you watch your charts and listen to them? Or do you spend your time convincing yourself you're right? Rule number 2, never average down on a losing trade. That's one of the oldest and most dangerous habits in this business. Adding to a loser is like pouring water into a sinking ship. You're trying to fight the tide instead of floating with it. The market always tells you which way it's going, all you have to do is listen. Prices are never too high to start buying and never too low to start selling, if the market movement supports it. I used to break this rule myself when I was young and cocky. I thought I could bend the market to my will. Every time I tried to fight it, it punished me. Every single time. The market's bigger than you, bigger than me, bigger than any one trader. Respect it. That's why rules exist, to protect you from yourself. Now, let's talk about waiting for confirmation. The market gives you clues before it moves. A wise trader doesn't guess, he waits. A fool tries to anticipate every turn. A professional waits until the turn is already underway. Do you see the difference? The fool tries to predict, the professional reacts. And if you remember from our discussion in the previous video on 4 mistakes traders make, one of those mistakes was jumping in too early, trading on impulse rather than signal. This principle is the antidote to that. I've seen men ruin themselves because they couldn't sit still. They had to do something. But trading isn't about action, it's about patience. The big money, the real money, is made in the waiting, not in the trading. When the time is right, the market will ring a bell so loud you can't miss it. But most people are too busy making noise themselves to hear it. Another rule, keep your capital safe. It's your lifeblood. Without it, you can't trade another day. Never risk so much on one trade that a loss will cripple you. The market will always be there tomorrow. If you blow up today, you won't. Think of your capital as your ammunition. Would a soldier waste his bullets firing into the dark? Of course not. So why would you? And listen, never let your ego trade for you. The market doesn't care about your pride. A trader who argues with the tape is a trader who's already lost. Every trade you take should be impersonal, mechanical, and precise. The minute you start saying it has to go up, you're finished. Nothing has to happen in the market. Let's move to another one, ride your winners. Sounds simple, but few can do it. You'll never go broke taking small profits. They say, but you'll never get rich that way either. It's the big moves that make the money. A trader must learn to sit tight when he's right. The market rewards patience and punishes impatience. The trend is your friend until it bends, and when it bends, you obey. That's all. Now tell me, have you ever sold too soon? only to watch the price run another 20 points in your favor. That's one of the hardest lessons to learn. I've done it myself more times than I care to count. The temptation to take a quick profit is powerful. But if your analysis was sound and the tape still agrees, let it run. The market doesn't pay you for being early, it pays you for being right. Here's another simple rule: keep records. Every trade you make should teach you something. Write down why you entered, why you exited, what you saw, what you felt. You think you'll remember, but you won't. The market is the best teacher in the world if you're willing to learn from it. Every mistake has tuition attached, don't waste it. And don't forget, the most important chart you'll ever study is not the one on your screen. It's the one in your own head. Trading is a mental game. You can have the best strategy in the world, but if your mind isn't disciplined, you'll sabotage yourself. Wealth doesn't come from cleverness. It comes from control of your emotions, your impulses, your greed. So when you sit down at that desk tomorrow, don't ask yourself, what will the market do? Ask, what will I do if it does? That's how a trader thinks. You plan your trade and trade your plan. If the market changes, you adapt. No emotion, no hesitation. Just logic, rules, and execution. Remember, the market isn't your enemy. It's your mirror. It reflects your strengths and your weaknesses. The better you understand yourself, the better you'll understand the market. The simple rules I'm telling you, they're not just trading rules, they're life rules. Protect your capital, control your emotions, wait for your signal, and when the time comes, strike with conviction. Protect your trading capital above all else. That's not just a suggestion, it's the foundation of survival in this business. Without capital, you're finished. You can't trade, you can't recover, and you can't learn. Every successful trader, every legend that's lasted in the market, understands this simple truth. The first goal isn't to make money, it's to keep the money you already have. Profit comes later. Preservation comes first. I've seen men with brilliant minds go broke because they didn't respect their capital. They treated it like a tool they could always replace. But you and I both know that once you lose your capital, the market doesn't stop to let you rebuild. It keeps moving day after day without you. That's why a trader must think like a general before a battle. You never waste your soldiers on a hopeless fight. Every position you take, every dollar you risk, must have a clear purpose and a clear defense. Ask yourself, do you protect your capital the way you protect your profits? Most traders don't. They'll guard a winning trade like a treasure, but they'll gamble with their account balance as if it were monopoly money. They think losing 5% or 10% is no big deal, that they can make it back. But that's the voice of inexperience talking. Lose 50% of your capital, and you need a 100% gain just to break even. That's not math, that's madness. Your capital is your lifeblood. It's not just money, it's opportunity. Every dollar you save from a loss is a dollar you can use for a better trade tomorrow. If you blow it all trying to prove you're right, you won't have another chance when the real move comes. That's why professional traders talk about risk management more than profit. They know the key to long-term success isn't how much you win, but how little you lose when you're wrong. You see, the market rewards discipline, not courage. It doesn't pay the man who fights the hardest, it pays the man who survives the longest. The moment you start taking oversized positions, you've already stepped into dangerous territory. Greed whispers in your ear, telling you to go bigger, to double down, to take just one more trade. But let me ask you, when has greed ever protected a trader's capital? When I was young, I used to think I had to be in the market all the time. If I wasn't trading, I felt like I was missing out. But the truth is, sitting on cash is a position too, and often the smartest one. There are times when the best way to protect your capital is simply to do nothing. Wait for the right setup, the right confirmation, the right signal. Cash is a position that gives you flexibility and freedom. The man who's fully invested has no options. The man who's liquid can act with precision. Protecting your capital means setting clear limits before you trade. How much are you willing to lose if the market turns against you? You must know that number before you ever click buy. And once you set it, you don't move it. The stop loss exists to protect you from your own emotions. Traders who ignore stops are like sailors who throw away their life jackets because the sea looks calm. The calm never lasts. You might think it's boring to talk about capital protection when all you want is profit. But that's exactly why most traders fail. They chase excitement instead of safety. They want the thrill of big wins, not the quiet satisfaction of consistent survival. But tell me, which would you rather be, the trader who makes a fortune one month and loses it the next, or the trader who compounds slowly, steadily year after year? This ties back to something we discussed in the previous video on 4 mistakes traders make. One of those mistakes was overtrading, jumping in too often, too big, without regard for risk. Protecting your capital is the cure for that habit. When you understand the value of preservation, you stop trading just to trade. You become selective. You wait for setups that truly deserve your risk. That's what separates a professional from a gambler. Let's be honest, losing money doesn't just hurt your account, it hurts your confidence. And confidence is essential in trading. Every unnecessary loss chips away at your belief in your own judgment. But when you protect your capital, even in losing streaks, you stay alive mentally. You know you can come back because you've managed your risk. That's what capital preservation really means. Not just keeping your money safe, but keeping your head clear. Protecting your capital also means resisting the temptation to chase the market. How many times have you entered a trade late after the move already started? Because you were afraid of missing out. That's not discipline. That's fear disguised as action. The market will always offer another opportunity. Missing one trade doesn't matter. Losing your capital trying to catch it does. It's not the big crash that usually wipes traders out, it's the small, careless losses that pile up over time. One unnecessary trade here, one emotional reaction there, and before you know it, your account has been cut in half. A professional trader treats every dollar like it's his last. That's not paranoia, that's respect for the game. And don't forget, capital isn't just about money. It's also about mental energy, emotional stability, and time. If you burn yourself out chasing every tick, you're wasting your most valuable resources. Protecting your capital means protecting your focus too. You can't trade well when you're stressed, tired, or desperate. The market senses weakness. It punishes desperation. So you learn to wait. You learn to risk small. You learn to step back when the market gets messy. You don't need to trade every day. You need to trade the right days. A professional trader knows that one clean, disciplined trade is worth more than 10 random ones. You can't control what the market does, but you can always control how much of your capital you're willing to expose. Remember this, the man who keeps his capital keeps his options. The man who loses it loses everything: his freedom, his confidence, and his future trades. That's why the real secret of trading isn't about predicting prices or finding the perfect indicator. It's about preservation, patience, and discipline. Let your winners run and ride strong trends. It sounds simple, almost too simple, but it's one of the hardest lessons to master in trading. Most traders can't do it. They grab a small profit and pat themselves on the back, then watch the same trade move 2, 3, 5 times further without them. Why? Because fear takes over. Fear of losing what they've already gained. The irony is that the same fear that keeps them from cutting losses also keeps them from letting profits grow. The difference between an amateur and a professional trader often comes down to this one rule: the ability to sit tight when you're right. I learned early on that it's not your entry that makes you rich, it's your exit. The market rewards patience, not prediction. Anyone can catch a move. It's staying with that move that separates the lucky from the skilled. You see, the big money isn't made in the buying or the selling, it's made in the waiting. But waiting is uncomfortable. The market will test you. It will shake the tree, make you doubt your plan, tempt you to cash out too soon. And most traders do exactly that. They take their profits before the move matures, cutting off their potential because they can't stand the uncertainty of open profits. Ask yourself, how many times have you closed a trade just because you saw a few $100s on the screen and thought, I'd better take it before it disappears. Be honest. Everyone's done it. But the truth is, that mindset is the opposite of what works in the long run. The goal isn't to take quick wins. It's to catch the big trends that pay for all the small losses along the way. Trading is never about being right every time. It's about making the most when you are right. The market has a rhythm, a pulse, and once it starts to move in one direction, it often continues farther than you expect. Human emotion drives prices to extremes. Greed pushes them higher than logic allows. Fear drives them lower than reason supports. A trader who understands this doesn't fight the move. He rides it. He doesn't sell just because he's up a little. He sells when the market tells him the trend is finished. And the market always tells you, if you listen carefully, you'll notice that in the previous video on 4 mistakes traders make, we talked about traders cutting their winners too soon out of fear. This principle, letting winners run, is the direct remedy for that mistake. When you trust your setup, your analysis, and the price action, you stop trying to outsmart the move. You let it work. You give it room to breathe. You trail your stop, not your emotions. Letting winners run doesn't mean you ignore risk. It means you manage risk intelligently. The key is to secure your position without choking it. Too many traders set tight stops after a trade moves in their favor, only to get knocked out by noise before the real move begins. The professional trader knows how to give his trade enough space. He moves his stop strategically, locking in profit as the trend confirms itself. That's discipline, not luck. Think about it this way: in any trading career, most profits usually come from a few big trades. The rest are small wins and controlled losses. If you cut your winners too soon, you kill your own edge. You remove the very trades that could have changed your account trajectory. The market doesn't pay for constant activity, it pays for strategic patience. Letting your winners run is how you allow probability to work in your favor. Have you ever noticed how the best traders seem calm when their trade is moving big in their favor? That calmness doesn't come from confidence alone, it comes from experience. They've trained themselves not to react to every tick. They trust the tape, not their feelings. They know that trends take time to unfold. Prices move in waves, with pullbacks and surges. If you panic at every dip, you'll miss the wave entirely. Riding a trend means embracing temporary discomfort for long-term gain. The market will always test your conviction. A strong uptrend will pull back just enough to make you think it's over, then surge higher without you. A downtrend will bounce just enough to tempt you to close your short, then collapse again. The trader who wins is the one who can endure those tests without flinching. But how do you know when to finally get out? That's where observation and discipline meet. The tape tells you when momentum is dying, volume fades, price stops making higher highs or lower lows, the character of movement changes. You don't need a crystal ball. You just need to watch what the market is doing, not what you want it to do. When the evidence says the trend has ended, you take your profits and step aside. Until then, you stay put. Most traders are impatient because they don't trust their own system. They don't believe that a trend can last long enough to reward them. But the market doesn't move according to your comfort level. It moves according to its own logic, driven by the crowd's psychology. If you want to be among the minority who profit, you must act opposite the majority. When everyone's afraid of losing their small profit, you hold. When everyone's chasing the move too late, you've already been in for days. You have to think of trading like farming. You plant seeds, that's your entry. You water them, that's your discipline. And then you wait. You don't dig up the soil every day to check if it's growing. You trust the process. The harvest doesn't come immediately, but when it does, it's worth the wait. Every premature exit is like pulling the plant out before it bears fruit. Remember, your job as a trader isn't to trade often, it's to trade well. You don't need 10 trades a week to make progress. One strong move managed properly can make your month. But you can't catch that move if you keep cutting your profits short. You must train your mind to detach from the small dollar signs flashing on your screen. Focus on the structure, the trend, the price behavior, not your momentary feelings. When you finally learn to let winners run, something changes inside you. You stop chasing trades, you stop fearing missed profits, and you start understanding that the market rewards patience over excitement. You realize that true control isn't about reacting, it's about waiting. The big moves take time to develop, and most traders miss them because they can't sit still long enough to see them through. Letting your winners run is about trust in your method, your analysis, and your ability to stay calm under pressure. The market doesn't need you to predict, it needs you to endure. You can't force the move, you can only follow it. The trend is your friend until it clearly ends. That line has been repeated so often in trading circles that it sounds like a cliché, but the truth behind it is as solid as bedrock. Every successful trader who's lasted long enough to call this a profession knows that understanding and respecting the trend is what keeps you alive in the market. You can try to outsmart it, fight it, or deny it, but sooner or later, you'll learn that the market always moves in waves, and those waves have power far beyond your opinions or predictions. When I started trading, I thought I could pick tops and bottoms. I thought catching the exact turn was the mark of a true professional. But the longer I traded, the more I realized that calling tops and bottoms is a fool's game. The real professionals don't fight the tide, they ride it. They wait for confirmation that a trend is in motion, and then they join it. That's the difference between guessing and trading. The market doesn't reward bravery, it rewards alignment. You ever notice how a strong trend has a way of pulling everyone in? At first, only a few sharp traders recognize it. Then, as prices keep moving in one direction, more people jump aboard. Eventually, the crowd comes running. That's when the move gets stretched, and that's when the danger starts. Most traders get in too late, just when the trend is about to end. So, the key isn't just to follow the trend, it's to know when that trend has run its course. Because once it ends, your friend can turn on you fast. Trends reflect the psychology of the masses. Every move on a chart is the collective result of fear, greed, and expectation. That's why studying charts isn't just about numbers or patterns, it's about behavior. When a stock or currency starts trending, it means the crowd is in agreement for now. Buyers or sellers have taken control, and until that control shifts, there's no reason to bet against them. Fighting a trend because you think it's gone too far is like stepping in front of a moving train because it looks tired. The train doesn't care how you feel about it. A trader who understands trends knows how to read momentum. They know that trends tend to persist because of human inertia. People are slow to change their minds. When prices rise, optimism grows and more buyers appear. When prices fall, fear spreads and more sellers join. That self-reinforcing loop can continue much longer than logic suggests. Have you ever watched a stock keep going higher after everyone said it was overbought? That's the market showing you that emotion beats logic in the short term. In the previous video on 4 mistakes traders make, we talked about how traders often try to predict reversals instead of following confirmation. That mistake directly ties into this principle. When you respect the trend, you stop trying to be the hero who calls the turning point. You stop saying it can't go higher or it has to bounce soon. You start saying I'll stay with it until the market tells me otherwise. That shift in thinking is what turns an amateur into a professional. The trick, of course, lies in knowing when the trend ends. Because no trend lasts forever. They all have their expiration point, and the signs are always there if you pay attention. Volume dries up, momentum slows, the price stops making higher highs or lower lows, and the character of the move changes. The tape becomes heavy or hesitant. You might see sudden sharp reversals that don't fully recover. Those are the whispers of change. That's when a smart trader tightens stops, reduces exposure, or prepares to reverse position. But too many traders ignore those whispers because they're blinded by greed. They think the move will go on forever. That's why they give back their profits at the end of every strong trend. They forget the second half of the rule until it clearly ends. The trend is your friend, yes, but only while it lasts. When the market shifts, you must shift with it. That's not fear, that's survival. Think of trading like sailing. You can't control the wind, but you can adjust your sails. The trend is the wind in your favor, it carries you forward. But when the wind changes and you refuse to adjust, you'll capsize. The best sailors, like the best traders, read the signs early. They don't wait for the storm to hit, they prepare when the first clouds appear. That's how you stay in the game while others sink. Another mistake traders make is assuming every pullback means the trend is over. That's not always true. Trends breathe. They correct, consolidate, and then continue. The key is learning to distinguish a normal pullback from a genuine reversal. A professional doesn't panic at the first sign of red, they study the structure. If the move holds key levels and the momentum returns, the trend is intact. If it breaks major support or resistance and fails to recover, that's when you know the tide has turned. Ask yourself, how many times have you closed a trade because you thought the move was finished, only to see it keep going in your original direction? That's impatience talking. The market rewards those who can ride the middle of the wave, not those who jump off too soon or dive in too late. You don't need to catch the first or last tick of a trend, you just need the middle part, where the real money lies. And remember, following the trend doesn't mean abandoning judgment. It means aligning your analysis with reality. Too many traders get attached to their opinions. They see the market rising and still cling to a bearish outlook because they believe it's overvalued. But the market doesn't move on belief, it moves on behavior. Price is truth, and the trend is the expression of that truth. When you respect the trend, you stop fighting the tape. You start trading with the flow instead of against it. You use pullbacks to enter, not to panic. You ride the wave, but you also keep your eyes on the horizon for signs of change. That's the balance every trader must find: the discipline to hold while it's working, and the awareness to exit when it stops. The market doesn't reward the boldest or the smartest, it rewards the most adaptable. You have to move with it, not ahead of it. Trends are the footprints of big money, institutions, funds, and major players. You can't control them, but you can follow in their direction. When they start to exit, the footprints fade, and that's your cue to step aside. Traders who survive year after year aren't magicians, they're observers. They don't guess where the market will go, they follow where it's already heading. They know that fighting the trend is like trying to swim upstream, exhausting, dangerous, and unnecessary. Master your mindset, the market mirrors your discipline. That might sound philosophical, but it's the most practical truth in trading. Every chart, every price swing, every spike or dip you see on the screen is nothing more than a reflection of collective psychology: fear, greed, hesitation, and confidence. And if you're not aware of your own mindset, the market will expose it faster than you can blink. Trading isn't just about strategy, it's about self-control. You're not trading against other people, you're trading against your own emotions. When I started, I thought success came from studying the market, chart patterns, technical signals, and price formations. I spent years learning those things. But over time, I realized that even the best system means nothing if the person using it can't control themselves. You can give two traders the same method, the same setup, the same indicators. One will make money, and the other will lose. Why? Because the difference isn't in the system, it's in the mind that executes it. The market is a mirror. It reflects your strengths and your weaknesses. When you're greedy, it shows you greed's consequence. When you're fearful, it punishes hesitation. If you're disciplined, patient, and deliberate, the market will reward you for it. Tell me, how many times have you taken a trade you knew you shouldn't, just because you couldn't stand sitting on the sidelines? That's not strategy, that's emotion running the show. Mastering your mindset starts with understanding that trading isn't about being right, it's about being consistent. The need to be right is one of the deadliest impulses a trader can have. You see, in everyday life, being wrong feels like failure. But in trading, being wrong is normal. The best traders in the world are wrong half the time, sometimes more. The difference is that when they're wrong, they lose small, and when they're right, they win big. The average trader does the opposite, holds onto losses and cuts winners short all because of emotion. You have to train yourself to think in probabilities, not certainties. The market doesn't owe you anything. It doesn't care about your prediction or your plan. All you can control is your reaction. When you understand that, trading becomes simpler. Not easier, but simpler. Because now, instead of trying to predict the future, you're managing yourself in the present. It's funny how traders talk about controlling risk, but forget that emotional risk is the biggest one of all. Fear of missing out, fear of loss, fear of being wrong, those are the emotions that destroy accounts. You can't eliminate them, but you can manage them. That's where discipline comes in. Discipline is the bridge between your knowledge and your results. Without it, even the best ideas fail. Do you remember in the previous video on 4 mistakes traders make, we talked about emotional trading, chasing moves, revenge trading, and ignoring rules after a loss. That mistake is exactly what this principle is designed to fix. When you master your mindset, those impulses lose their grip on you.